Hey everybody, Marty Missouri. Good evening, April 5th, 2018 video. Going to try to keep it quick for you as I speak. And the reason I'm coming to you this evening is if the Dow were to open right now, it would be down some 400 points. NASDAQ would be down percentage-wise almost as much, about 83 points. After a really nice rebound day before yesterday and then a follow-through in today's market, all based on calming commentary from White House officials about the pending trade actions between the U.S. and China, that these tariffs may indeed not ever fall into place pending some solutions via negotiation. Markets love that. We've talked about that a lot on the blog. I mentioned the other day that we get these violent declines when we hear rhetoric that opposes that, and then we get these passionate rallies when we get the kind of rhetoric that we've got the last couple of days. Well, for whatever reasons, the president stepped back into the fray this evening and said he's asking our trade representatives to come up with another 100 billion of tariffs against China. And of course, the minute I heard that, I looked at futures and they began falling quite noticeably. They seemed on the Dow to stop at about 400 points, but could be a lot more than that actually in the morning. Right now, this is still noise. The macro backdrop, as we assess it, is still very bullish for long-term investors to own stocks and to keep a very cyclical bent in their sector allocation. So folks, that's what we do here. We don't let the noise deter us. We pay attention to the general conditions of the market fundamentally and the technicals. And while the technicals have exhibited some stress here of late, which they always do during periods of correcting markets and volatility, the longer-term trends remain. And that would be the technical longer-term trends and the scoring of our own proprietary index, which includes 81 data points, is still quite robust. So the conditions are there for the market to weather a storm. A global trade war, on the other hand, would be a major storm because we believe that the global economic consequences and thus the market consequences would be very destructive or severe, perhaps. It's unlikely to happen. The political risk there is much too great. So that we believe odds favor, despite tonight's rhetoric, that cooler heads will ultimately prevail because it's in the best interest of those cooler heads. So in the meantime, I wanted to talk about the reality of the market, the reality of volatility without regard to what's causing the volatility. Now, the screen in front of you is that familiar daily chart for the S&P 500 index. This one goes back to the beginning of the present bull market, which was March 9th of 2009, on record now as being the second longest bull market in history. And it has, ironically, very similar looking charts to that longest bull market that finally ended in the year 2000 or so. So again, with the chart, these yellow lines here, they represent retracement levels, technically the Fibonacci retracements. These are named after, obviously, the 13th century mathematician who discovered a sequence of numbers that have significance in many different areas of life and of the world. And technical traders and market technicians apply those to markets. And it's quite interesting how well these work as technical support and resistance indicators. So what I want to do with the indicators today is actually back up from where you see them there and go back to the beginning of the current bull market and show you essentially troughs to peaks and how rallies tend to retrace time and time again. So again, we're going to go back and we're going to begin at the very start of this bull market back in March 9th, 2009. And you can see we came bounding away from there, had a really nice year for most of 2009. Then late in the year, we peaked and we came down, and these three ratios, 38.2, 50, and 61.8, there's others above and below, but I got rid of those for illustration's sake, just to show you the key ones that we know traders act on the most. So here we had the market rallying up. And right in here at this 38.2% retracement, clearly traders had buy orders in after the peak, and you can see a lot of money went into the market, and that indeed served as resistance that stuck. So then the market came off of that. Now I'm going to move my peak. I'm going to move the top up here to the next peak, and then we're going to come down to where that little contraction there bottomed. And we can see the market came up and peaked, came down, almost touched the 38, came back up, struggled around the 50, came all the way down 2, 3, 4, 5 times under the 61.2, and then one big thrust, and then sprung from that level up and finally broke through the old high and created the new one. So now we're going to go to this bottom here. You're going to get my point here very quickly. I'm going to move the top up to where it peaked again, and lo and behold, came down 38.2, bounced off of that. Now I'm just going to keep on moving. So I'm going to move up here to the bottom. Now it's going to get so scrunched we're not going to be able to really tell, but here we came down, tested that very last retracement level. Interesting how the market often just comes right to that line and then goes bounding back up, and that is traders, folks. That's real life people and programs coming into the market and buying at what they believe are key technical levels, and you can see in many instances it's worked quite nicely. Here we are again, coming up, peaking right here, coming down. Traders came in, bought it very hard, and we keep just moving on up in a long-term bull market as it's being generated and created here. My point here today is along the way, it's never a smooth straight line. There is always going to be volatility and these retracements. Again, as you can see throughout much of this bull market, that 38.2 Fibonacci level was key, and traders, short-term traders, made a lot of money, maybe selling on the rollover and then buying again on that 38.2% retracement. So I'm just going to keep going here. So clearly we can see a peak right there, and then we had a pretty good sized correction. Let's see, I guess I'm right here. Yeah, so here we came down, touched the 38 they bought, then right in here, not so good, came down just below that last retracement level that I'm illustrating here, and then we came bouncing off of that strongly. Now I'm going to move back up to the very next peak, about right there. This comes back to here. Here we are peaking here, coming down. This one struggled. Now, in this case, we got that rare 100% retracement. Again, still within the context of an ongoing bull market. And this is where that last decline during this long 2-year consolidation period that I've illustrated here many times, bounced off of that, and then we kind of moved up and well into all-time high territory. So I'm going to move this here. You can see we peaked right here, came down, didn't even quite get a 38% retracement. So if I move this all the way up to the recent peak on January 26th, as you can see, if you go back here to February 12, 2016, by the way, this was the worst start to a year in market history at the beginning of 2016. So that's a good bottom to work from. As you can see, folks, we still have not even retraced to that first level retracement in this particular rally. But if you want to use a different bottom to start, here is the Brexit low in mid-2016. Brexit caused a lot of consternation for the market. Here we came back and tested exactly that 38.2. Looks like we're going to try that again, and I'm probably going to try that again tomorrow. But what I'm illustrating for you folks, this particular rally can go quite a bit further, and we would still be very much within the ongoing bull market. If you want to move here and call this the election low, then you can see that we have tested it successfully, testing it right now as we speak. If this trade rhetoric keeps up, we're easily going to come down and test lower levels. But my whole point here this evening, folks, once again, while the noise is concerning, no doubt about it, we made it a very strong point at the beginning of the year that the one risk that we thought would test our bullish thesis would be protectionism. Right now, we're getting the rhetoric of that. We did get the steel and aluminum tariffs. We are seeing some negative effects. I've talked about those in some of the business surveys already. Those by themselves, we think this strong setup can absorb quite successfully, and we still see rising corporate profits and so on. We're not seeing a lot of deterioration in the sentiment indexes. We're seeing concerns, but not deteriorations in the data. this threat of a big trade war starting with China and the numbers that they're talking about, we think that has more serious implications. And obviously, the market thinks so too. Those serious implications, though, would suggest that odds strongly favor that indeed, as certain officials have suggested, that the sides will ultimately get together. And as I said earlier, that cooler heads will prevail. So for today, folks, I'll leave it there. Again, just wanted to show you what normal volatility looks like. And that's what is happening as I speak at you here today. But of course, there's lots more to come, and we will definitely keep you posted. Thanks as always for watching and listening, and I'll talk to you again soon. Bye-bye.